Hey guys, as soon as I posted my video on how I enter stocks, a lot of you started asking if I plan to make a video about how I exit my trades. And you said that you want to know about how I manage them, how I take profits, and how I move my stops up to break even specifically. So this is going to be a video about my sell rules. And I think the sell rules are even more important than the entry rules themselves because everyone's going to have the same entry for the most part. We all look at the same charts and enter when they're breaking out. It's really not rocket science. And honestly, most kids can do it as well. What really differentiates a good, consistently profitable trader from one who's consistently losing money is their sell rules. And in this video, I'm going to talk about all the different aspects of the sell rules that I've developed for myself over the years, which have kept me profitable and my drawdowns as low as possible. So this video is going to talk about 4 things in particular. I'm going to start with how I plan my exits at the time of my entry. And this is really important to do. A lot of people I see for some reason don't do that. They'll just blindly enter into a breakout and then think about exit later on, which is a very easy way to incorporate your emotions into a trade, which is detrimental and will not make you a pro trader. The second is I'm going to talk about when I move my stop loss up to break even. This is another common question that I get asked a lot, and there seems to be a lot of confusion on this. And if you do this right, then this will help keep your drawdowns really low. The third is I'm going to discuss my rules for taking profits. And lastly, I'll go through my rules for booking a loss. And I know no one likes to talk about this or think about taking a loss, but that's actually the most important of the rules. It's even more important than when to book a profit. So this video is going to be divided into 4 parts, and I hope by the end of it, you have a really good sense of what your exit strategy should be and everything that you need to know about when to sell. So I'm going to talk about how to plan your exits at the time of entry first. And some of you seem to realize the importance of this, and a lot of you have been asking, how do I determine the magnitude of my trades and how do I plan this at the time of entry? So in this video, I hope to make that very clear, very logical, and show you examples of exactly how I do it. So at the time when I'm entering a trade, I always ask myself one simple question. Is this going to be a position trade or is this going to be a swing trade? Now, what is the criteria for a position trade? It's these 2 things. Either the stock has had a bull snort, and I'll explain what that is as well as go through a few examples, or the stock is breaking into a bull cycle, which is based on the cycle of price action. And once again, I'll show you examples of what that looks like as well. So these are the only 2 cases in which I'm going to treat a trade as a position trade. Now, in all other conditions, I'm going to take a trade and treat it as a swing trade. And I'll discuss exactly what the rules for selling a position trade and swing trade are. But let's first go through the criteria of how to determine which is what. So in all other conditions, every trade I take is going to be a swing trade. If the market indexes are extended, which means either QQQ or SPY is extended from the 50 moving average, it's going to be a swing trade. And the reason behind why this is important for me to keep an eye on, or really for anyone, is if the indexes are at extreme levels, that means that the likelihood of a pullback is extremely high and right around the corner. And this is not going to only affect just the indexes, but all the indexes that make up, but all the stocks that make up that index, which is going to be every stock. So they're likely to fall in line with what the indexes are going to do. Also, I'll be focusing on swing trading if you need to build portfolio traction, which means your account is not doing well. You may have had a rough year or we're in a bear market or a choppy market or a late stage bull market, these are the times where it's going to be very difficult to build portfolio traction. And those are the times where I will be swing trading specifically. Now, if there's upcoming news events, either about a particular stock or the market in general, like let's say an FOMC or some sort of CPI data or whatever really the market is focusing on at that time, and I'll go through examples of that as well, once again, I'll be swing trading. So just keep these in mind for now. Hopefully it will be very clear by the end of this video. But this is a chart that I've written down and printed out and put up on my desk. So I always know at the time of entry whether I should treat the trade as a position trade or a swing trade. And just a side note, in case you're a complete newbie and wondering what position trading and swing trading even are, there is a very simple definition for both. Position trades are much longer term trades that you plan to hold for a few weeks to months. And swing trades are trades that you hold for 3 to 5 days at most. So just keep that in mind. I'm going to go through the exact sell rules for each in a later section. But first, let me take you through a few examples of each of these 5 conditions so you know what they mean. The first is if a stock has a bull snort. In that case, you're going to treat it as a position trade. Now, a bull snort is a super powerful setup. It's one of my favorite setups personally. And it basically means that a stock has had a really strong catalyst on news or earnings that came out, which completely changed the growth trajectory of that stock and oftentimes sets the technical trend for that stock going forward. So Unity Software, a recent example from this month, June of 2023, received a powerful catalyst on the day of this very strong bullish candle. And I could show you what the news looked like. So on this day, during the final hours, news came out that Apple announced partnership with Unity, and that led to the stock moving up 25% in less than an hour. Generally speaking, I'll find out about the news after I already seen the stock make the huge advance, because that huge advance is what really catches my eye and causes me to look further into what is causing this kind of reaction. Now, if I were to buy a stock on this day, because I find that news is really positive, I would treat this as a position trade and hold it for a much longer time. So this is something for which you don't really have a formula. It's very subjective, and you have to use your common sense about whether a particular catalyst on news is a game changer for a company or not. And if it is, then you treat it as a position trade. Just because you see that stock surge and that catalyst is something that intrigues you and you believe can have a long-term impact, doesn't mean that you necessarily need to enter it the day of. You could do what I often like to do, and that's wait until that stock pulls back, and then you put a position on. Now, the other case in which you would treat a trade as a position trade versus a swing trade is if a stock is breaking into a bullish cycle. So if a stock has been in a downtrend or gone through an extended period of consolidation, say for a couple months, and it breaks above the 10 and 21 EMA, like in this case, the stock is entering a bullish cycle. And once again, this is based off this cycle of price action. And as you could see, when looking at the chart of NVIDIA, the move up can last a considerable period of time if the trend is very strong. In this particular case of NVIDIA, it advanced, I think, over 50%. But that's more on the extreme side of the spectrum. Generally speaking, you don't see this strong of an advance. But either way, when you do break into a new cycle, that's the time where you want to give that stock more room, because that's where you could see the largest advances and you get the best risk reward. So these are the 2 conditions in which I would consider for position trading. And to recap, 1 is if the stock has a bull snort, like Unity Software did. And 2 is if the stock enters a bull cycle. And there are a few exceptions to this, meaning there are some times where even if we're in a fresh bull cycle or I see a bull snort, I'll still treat it as a swing trade. The first exception is if you need to build portfolio traction. In that instance, you're going to want to continue to focus on swing trading only and not position trading at all. And that's really no matter what. Now, what do I mean by portfolio traction? It means if my account has been going down, so say this is the usual equity curve, and this is what all equity curves should look like if you're a consistently profitable trader. But as soon as you start getting drawdowns or long periods of time where it's just moving sideways and the account really isn't seeing any traction, those are the times you're going to pivot your focus to swing trading. And that means you want to look to be quickly booking profits and racking up gains as opposed to getting in longer term trades like position trading. And this is very important because it helps keep your mental in the right place and reinstill confidence in yourself as a trader, but also in the trading strategy that you use. Now, usually your portfolio is not going to get a lot of traction during bear markets or choppy markets or while in a late stage bull market. So throughout the last 2 years, we've gone from a late stage bull market into a bear market and then into a choppy market where we were forming our bottom. And my account has pretty much been moving sideways throughout that period of time. This is not an actual screenshot of my equity curve, but this is pretty much what it looks like since the time I became profitable. And up until February, my account was kind of going sideways and I wasn't getting as much traction as I would like. So I was actively swing trading and very rarely willing to take a position trade. Because first, what I want to do is rack up some gains and start to see my equity curve go up. That is, after all, our first and foremost job as a trader. We want to build that cushion for the year. And then once we have that cushion, we start to hold positions for longer. Now, in case you're confused about what portfolio traction is, or how I size my trades, or how to make sure that your drawdowns are just sideways or at the very most single-digit low drawdowns, I will make sure it is very clear in the upcoming video that I plan to make, at which I'll be covering position sizing and progressive exposure in finer detail. This topic is extremely important because it's the number one thing that's going to determine your success as a trader. It's even more important than sell rules themselves. And what I'll do in that video is try to take you through an example using hypothetical trades and talking about how your total equity would change and what the changes in the profit and loss would do to your equity curve. So before you ask me questions on what portfolio traction is and how to go about thinking about it, please know most all those questions will be answered in the upcoming video. Now, the other exception for when you should trade and not position trade is if there is news and events. So what do I mean by that? There's a news calendar for all US news events and announcements. It's on a website called Forex Factory, and I'll even link it in the description below. But basically, you want to be checking that regularly. And the big papa for all these events is the FOMC meeting. FOMC is the Federal Open Market Committee, and this is where the Fed announces whether it wants to increase rates or decrease rates. And in the environment like we're in right now, where we have high inflation and the rates are extremely high, every single FOMC meeting moves the market up or down. So the catalyst itself might change from time to time. Like during COVID, it was the death numbers and that type of data that was causing market fluctuations. And right now, it's inflation data like the core CPI or it's the FOMC minutes. But regardless of what the catalyst is, you want to be swing trading when there's impending news and not position trading because your risk increases greatly. There's no way that neither I or you can know what the Fed chair is going to do. So rather than holding all of our open profits at the mercy of JPOW, what I do is I go into defense mode and start to book profits as we approach the event. So a great question I received recently was, how do you prefer to manage positions around data events like the Fed? Like this week we have CPI, PPI, things like that can move the market. I tend to go flat into those events and just reevaluate after, but curious on your thoughts. So what I simply do is play defense. So I won't have more than one or two positions that are not already profitable in my account. And I start to take partial profits to build up cushion in my account. So really, in short, I'm reducing exposure and building cushion. And if at a time like this I'm taking new trades, it's definitely going to be swing trades, not position trades. And that's simply because you don't want to be increasing your market risk when the market itself is about to receive such a large amount of information that it's going to then need to factor in. So hopefully that makes sense. And let me just go back to show you the chart. Hopefully you have a better idea of what the criteria is for when you want to position trade and what the criteria is if you want to swing trade. Now I'm going to talk about when to move the stop loss up to break even. And this seems to be a really common question, something that people really struggle with a lot. And a lot of you have asked me if I could talk about when and why I move my stops to break even and what rules determine when it's time to do so. And surprisingly, the answer is really simple for me. Depending on whether the trade is a position trade or a swing trade, the rules are extremely simple. That's the kind of system I like. And we just went through what the criteria was for determining whether a trade is a position trade or a swing trade. So if you're still unclear about that, I'd recommend first reviewing that before moving on. But for all position trades, I move the stop loss to break even after the first natural reaction. And for all swing trades, I move the stop loss up to break even after 1R. It's really as simple as that. It doesn't need to be any more complicated. So let me show you what I mean by both of those. An example of a natural reaction would be this trade of Nvidia that I took. So I entered here when the stock moved out of this base. And as you could see, it went up a lot on heavy volume. But since it was a position trade, I was in no rush to move the stop from where it was initially placed, which was low of day. Instead, I wait for the stock to pull back, make a new low, and then once it starts pushing higher, I'll move that stop up to break even. So initially my stop loss was the low of day and price came down. I didn't panic. In fact, it was actually very generous because it didn't come down much. So I wasn't testing my emotions or anything like that. But I waited until price started to go up again and take out the resistance. Then I moved my stop up to break even and then eventually moved it to here. The basic idea is that when you're in a position trade, you don't want to be too hasty to move your stop up to break even because that can cause you to get shaken out and often lose your position in that trade. You want to be patient and you want to kind of give that stock some time to come back down a little bit, have that natural reaction before moving up further. Once it does move up further, you'll then move your stop up to break even. I find this rule to be really logical when I'm taking a position trade, so I just keep it simple, and this is my only rule for position trading. To be clear, a natural reaction is simply the pullback that follows the breakout move. So in this example, we have our breakout move, and then we have the natural reaction that follows. Every stock will have a natural reaction after the initial thrust up. It's just how stocks move. After that stock has that natural reaction and makes new highs, like so, we're simply moving our stop loss from the initial the initial low up to break even. And then as it continues to have these reactions, we continue to move our stop loss up. If it goes through a period of basing, like we see right here, we keep that stop loss put. And then once it breaks out again, it's going to do the same thing, have that natural reaction, and continue to push forward. Just want to make that clear. Now, If I'm taking a swing trade, on the other hand, since I'm only holding it for 3 to 5 days, I don't want to wait for that natural reaction. So the whole idea of this, of swing trading, is that you don't want to get caught in that pullback or those natural reactions. Instead, you want to sell into strength. So the way I would treat a swing trade is as soon as the stock goes up 1R, I make it safe and move the stock up to break even. Now, what is 1R? It's simply a risk multiple, and it's the amount that you're risking in that trade. So say I'm risking $100 in a trade, which means if my stop loss is hit, I'm going to lose $100. Now, for that stock to go up 1R, it would mean that it advanced $100, thereby putting me $100 in profit. So if I had risked $100 on that trade, and the stock then advanced $100, giving me a profit of $100, I'm simply going to move the stop loss up to break even and make that trade free or safe. So I want to attempt to make this as crystal clear and easy to understand as possible before moving on, because I can understand this could be a bit of a confusing topic for a beginner. So let's look at Unity and really break it down. Our entry point, that purple line, is $39.43. The stop loss that we selected for ourselves is low of day, and between the points 39.43, our entry, and the low of day, we are risking $1.21. In order for us to move our stop loss from the low of day up to our entry point, thereby making the trade safe, the stock needs to advance 1R. So it would need to advance $1.21 from our $39.43 entry. Once it does, which is depicted by this orange line, we then take our stop loss and we move it up to where we entered. That trade is now safe. If price is to advance 2R, or 2 times our initial risk, which in this instance would be $2.42, we would then sell half of our position for a profit. We would let the rest of it work in hopes that the stock continues to advance higher and we can capture larger gains. But meantime, we've already locked half in, which helps kind of ease your emotions. And we also know that the worst case scenario is we get stopped out at break even on the remainder of the position. So you might be asking, what exactly does it mean when a trade is safe? It means if my stop loss is hit, I'm going to be exiting break even. So I'm going to exit exactly the same price that I entered it on. And with that being said, I'm not going to make any money, but I'm also not going to lose money. So it's effectively a free trade. So quick recap. Once you identify your initial risk, which in this case was $1.21, as soon as that stock moves up 1 times the initial risk, or 1R, I move the stop loss to break even, thereby making the trade free. As soon as Unity moved up $1.21 from the entry point, my stop loss was then moved. So really simple rule that I follow for all my swing trades, and most of my trades are actually swing trades, as I'm primarily a swing trader. As soon as that stock goes up 1R, I just move it to break even. And that makes sure that I don't lose any money on that trade, really allows your emotions to relax, and gives you the confidence to let that stock work. And if you keep your rules as simple as this, you're going to make sure that your drawdowns are as small as possible and your life is as little complicated as possible. Every time you take a trade, you're not going to be asking yourself, okay, when should I make the trade safe? When should I move the stop up to break even? So just create rules for yourself that make sense to you and that simplify your life in your trading. Now, the other thing to keep in mind is once you've made your stock safe, how do you trail that stop loss up? And for me, again, that's a very simple answer for all stocks, whether they're swing trades or position trades. if they pull back and start going up again, I move the stop loss to each previous swing low. So let's revisit NVIDIA to really train our eyes on what to look for. This is where I entered. This was my initial stop loss. I had taken it as a position trade because this was a flat base breakout that formed following a large earnings gap from earlier that month. If we were really to get into the technical aspect of things, what really incentivized me here was the fact that the gap was what we would call or refer to as a runaway gap, which marks the continuation of a trend, which in this case was obviously an uptrend. And this gap is also technically a bull snort, which we learned about earlier. Now, as soon as it made a pullback and started going up again, I moved the stop loss from the initial low of day up to the previous higher low. And I really just continue doing this as the stock, progresses. I was fortunate enough to be in it while it had this huge earnings gap up, and I'm holding on to it till this day. And this is all from following a very simple system. It's very important to recognize that when you're moving systematically, you're more or less eliminating emotions from the equation, or at least suppressing them. So it makes it a lot easier to stay in a trade and let it work. So I just wanted to show you how I trail my stop loss. And the reason I do it this way is because it's very logical to me. If a stock is in an uptrend, it should be making higher lows. And all I'm doing is moving the stop up from one higher low to the other. Now I'm going to go through the sell rules for how I sell a position trade specifically, and then a swing trade. And just to recap, a position trade is when you're holding for weeks and preferably months. And a swing trade is something that I want to hold for a few days, usually 3 to 5 days. So far, we've already seen that right at the entry, as you're taking a new trade, you want to think about how you're going to sell it. Are you going to position trade it, or are you going to swing trade it? These are the criteria for stocks that you should position trade. These are the criteria for stocks that you should swing trade. We also went through when you should move the stop loss to break even for a position trade, and when you should move it to break even for a swing trade. So now let's go to the main sell rules that I use for my trades. If I'm in a position trade, then I sell half the stock when it makes the third leg up. And I'm going to show you examples of exactly what I mean by that and the logic behind it. And I sell the other half either when the stock goes parabolic or when it breaks a trend line. For swing trading, the rules are also very simple. I'm just going to sell half the stock at 2R, which is twice the risk multiple. And we already discussed that. So I hope everyone has a good understanding of that. If not, just rewatch that portion. So now I'm going to show you some examples of what each of these criteria look like, so you have a good sense of them and also understand the logic behind them. Now, what do I mean by third leg up? So say this is a stock that just had a bull snort and it's starting its move up here. This is where I would enter. It goes up for a few days or weeks, makes a leg up, and then pulls back. Probably tests the 10, 20, or 50 moving average before having that next leg up. And then it repeats it and has that third leg up. Now, after 3 legs up, the probability of a fourth leg or a fifth leg greatly diminishes statistically. So what I do is I'll just sell half of it on the third leg up. Let me show you an example of this. This is Ramis, and this is a position trade that I took back in November when it had a bull snort off of an earnings report. And I actually had just recently sold it completely a few weeks ago. So Rambus makes the first leg up here. It's a very strong move. And even though it may not look like it, this stock actually moved up 43% during this period of time, which for a stock like this, which generally doesn't move like that, was very impressive. But what really made it eye-catching was the fact that it was doing this in the midst of the bear market of 2022. So while all the other stocks in tech were getting burned, this one was holding up very well, actually marching forward. So after that first leg up, it pulls back, finds support on the 50 moving average, which for some reason I don't have pictured here, but I do recall very vividly. It forms a nice base before making a second leg up. The bull snort, which is where I entered, occurred about halfway through the second leg up, which is something that you want to take note of. Which leg are we on right now? It then completes that second leg up and begins to move sideways in a tight range for a couple of months before breaking out and beginning that third leg up. Now this is where I'm really beginning to pay attention, and I would start to think about selling. And keep in mind, I'm not selling it when the stock is on its third leg up from my entry point. I'm selling half when the stock itself is coming off its third leg up. And since this was the third leg up, for it to make a fourth leg or a fifth leg up, it's definitely possible. I mean, you could even look at this chart. It's on its fifth leg up now. But from a probability standpoint, it's very unlikely that that does occur. So what I typically do is I'll sell half of it here when that third leg is looking quite extended to me. And then if it breaks out again and tries to make a fourth leg up, I'm happy to trade it, but I'll take it in the form of a swing trade because it's already a very old trend. So that would be the first case. That would be where I would sell half my position trade. Now, the other half, I'm either selling it when that stock goes parabolic or when it breaks an important trend line. So let me show you what a parabolic move looks like. Now, the definition of a parabolic move is very simple. All it means is that the angle of the stock has changed. So if you look at Nvidia here, this is the angle at which it had been going up steadily. And then all of a sudden, during this leg up, which happens to be its fourth leg up, the angle changed considerably. It became a lot steeper. So when I see the angle changing and the stock kind of going wild relative to how it would normally move, it really catches my eye. And it's telling you that the stock is going parabolic. And in this case, Nvidia advanced 70% in about a month and a half. Now, keep in mind, this is a mega cap name. So this is a stock with market cap equivalent to Apple, Microsoft, or close to it. So when you see a name that is generally not going to move that quickly, rocket like Nvidia did here, it's something to take note of because it's potentially putting in what's known as a blow off top, which almost always marks the end of a trend. And that's when I would sell the rest of my position. So I would get out completely from the stock. And if I didn't get out following that parabolic advance, I would have a second clue as to a top being put in. If you look up here, you could see that the stock became very volatile and the volume remained very high. And the price of the stock was not advancing despite this. So this type of price action is known as churning. And when you're getting a churning of the price action, it essentially means that institutions are swapping hands with public and exiting because they believe that that top is in. So when you see churning, that's indicative of a stock being distributed and a major red flag. It's essentially when the public is most euphoric. They've been programmed throughout the rise of the long bull market that nothing can go down. And when they see Nvidia rocketing up 70% in a month or two, they say this thing is going to go to the moon. They're adamant on getting involved. They don't care about a pullback. They just want to get in. And institutions take advantage of these emotions and they unload all of their position and then wait for the next opportunity to get in, which would come at the bottom of a bear market. So if that scenario does occur, be very careful, and you want to think about reducing your exposure or exiting completely and just booking your profits. Because once it's gone up parabolically, it usually falls super fast and you may not even get a chance to get out the price that you initially purchased. So if you don't want to be in for any kind of surprise like that, it's best just to sell into the strength and and just get out while you see it going parabolic. The last reason that makes me get out of a trade completely is if a stock breaks a major trend line. So a lot of people may have heard of a rule that if it closes below a moving average, you want to sell the stock. Most commonly, it's the 200-day or 50-day. And that's what I used to use previously, but I found that I used to get shaked out quite frequently. My voice is starting to go. And a better, more logical way that I've found to do this is to draw a trend line instead. And once it breaks the trend line, to sell it at that point. So this is the same NVIDIA trade that we were discussing. And although it would have been best to sell during this parabolic advance, there were other options. Say you missed that sell point. You could draw a trend line which is when it touches 3 price points at a minimum. And that's when it becomes a valid trend line. Because otherwise, really, if the criteria is only 2 points, you can connect any 2 points and draw a trend line anywhere, really, and therefore it's not significant. But once it's connecting 3 lows, that makes that trend line meaningful. And so on this day, when it broke that trend line and closed below it, that would have been where the rest of your position would have been closed out. Now, for a swing trade, the sell rules are just as simple. I just sell half at 2R and then the other half in 3 to 5 days. And just a quick refresher, 1R is the equivalent of 1 times the risk taken in the trade. If your stop loss is $1 away, that is your 1R, meaning 2R is simply twice that. So this was a recent trade that I closed. This was last week. I had entered United Airlines on this day when it broke this trend line. A couple days into the trade, it had gone up 2R, and that's when I booked half my profits. And then on the 6th day, I sold the remaining position. Normally, I sell half 3 to 5 days up. In this instance, I lost track. Not proud of that. Thankfully, it didn't work against me. But oftentimes, you won't get that lucky. But in total, it went up 9% from my entry point. And the options I purchased closed up 80%. And I closed the trade in 6 days. So this is a classic example of a swing trade that I would take and the super simple sell rules that I use to manage them. The logic behind selling half at 2R is that it finances my risk. Say I would have risked $100 in the trade. If the stock goes up 2R, that means I'm sitting on $200 profit. If I'm selling half of the position there, that means I'm booking a profit of $100. So I had risked $100 and now I've made $100 in my account. And I can then use that 100 profit to finance a new trade. And that's the logic behind selling a partial at 2R. It's really just putting some money into my account, recycling it, and putting it into a new trade, thereby giving yourself a chance to make even more money. And the reason I sell the other half at 3 to 5 days up is because most swings, most stocks, just go up in short intervals of 3 to 5 days. So even if you take a look at UAL here, this little swing was 4 days. This little swing was 3 days. This little swing was 3 days. It's really just the nature of how stocks move. And it's actually a very important concept to understand if you're a swing trader. But all I'm doing is using that structural tendency of stocks, which is to go up 3 to 5 days, and basing my sell rules around them. And that's the simple logic behind that rule. This is another example that I just took and I actually shared with everyone on Instagram. Just to give you another idea, a couple weeks back, I went long DraftKings, DKNG, and since it was a swing trade, as soon as it went up 1R, my stop loss was moved up to break even. And there was so much momentum in the name that day that it went up 2R. So I just booked half my profits the same day. So sometimes your swing trades can turn into, a day trade if you're lucky. And I let the other half work before closing the rest out somewhere up here. Now, I wanted to address one thing. When it comes to trading options, I deal with risk a bit differently due to the higher risk nature of trading options. And this is simply due to the fact that you're trading with leverage when you're using options. And I have to worry about other outside variables like the Greeks. So when it comes to options, I like to move my stop loss to break even quicker, as well as trim my position quicker. And this is because I find my emotions tend to run higher a lot easier when dealing with options. So I want to suppress them as soon as possible to neutralize them and really just allow me to better manage my position. So for options, I generally move my stop to break even at 0.5 R rather than 1 R like with shares. And I sell half at 1 R with options rather than 2 R. So I just wanted to share that for all of those who use options. Me, primarily, I trade in shares. In fact, 95% of my account is traded in shares. But it's really totally up to you how you want to manage your risk. Curate it to your personality, but this is what works for me. Okay, now I want to talk about when to take a loss. And unfortunately, I have no questions about this. Literally, no one seems to want to know when to book a loss, even though this is way more important than when to book a profit. And that's because if you let your losses get too big, not to be dramatic, but that's the end of your trading career and that's the end of your account. So the rules for this are super simple. Let me take you through them. So 2 situations that would possibly cause you to take a loss in a trade. One is when your original stop loss is hit. If that happens, you just get out. No questions asked. There's no ifs, ands, or buts. No exceptions. Your stop loss is hit, you get out. That's it. This is a simple rule itself, and it's what will save you from doing great damage to your account. You don't want to hope, don't pray that the stock will come back, or convince yourself it's just a minor dip. It's going to come back tomorrow. Whatever you use to validate your poor decision, poor judgment at that period of time. We've all done it. I've done it plenty of times. I've been there. It doesn't work that way. And it's just going to delay your progress. So remember this rule. This is really the golden rule of trading. No matter what system you trade, whether you're a day trader, swing trader, position trader, if your predetermined stop loss hits, get out. Now, there are 3 situations in which I would get out even before the stop loss hits, which means even before the stop hits minus 1 R. So the first is if there's not enough cushion at the end of the day. Now, what does that mean? Let's say I entered a stock at $100 and my stop loss is at 95. And at the end of the day, the stock closes at 96, which means it didn't stop me out, but it's very close to my stop loss. If we have a gap down in the stock tomorrow, then it could potentially open at 94, 93, or even worse. So I don't have enough cushion at the end of the day to absorb that, meaning I can't hold the stock overnight and risk a gap down. So what I'm going to do is exit it at the end of the day, and that would be a loss of 0.8 R in this case, and that would be perfectly fine because my goal is to never have a loss bigger than minus 1 R. Now, the second scenario is if I don't have enough cushion in the stock and its earnings report is coming out soon. So it's really the same logic here. If the stock is very close to the stop loss and I don't have enough cushion in a huge event like earnings, which could cause huge gaps, or some other news catalyst is going to come out in that stock after hours, then you want to get out because you don't want to risk a big gap down. The third condition is something that I learned from Jesse Livermore, and he calls it the stock is not quite ripe. And what that essentially means is maybe you bought a stock and you expect it to break out and continue to push forward up for the next 3 to 5 days, right? That's what we're looking for as swing traders. But that stock doesn't do that. It just keeps going sideways and drifting. Meanwhile, the rest of the market is breaking out, pushing forward. So the stock is kind of showing you relative weakness right now. Maybe it's even consolidating or moving sideways on a pickup in volume, which is not something that you want to see when a stock is consolidating. You always want it to be on light volume, right? So what you could do is just scratch it off. Sell it at whatever price it's at. Maybe it's near your break even. Maybe it's halfway to your stop loss. Whatever the current price is, take that risk off and perhaps put that money to work in something else better. If you're expecting the train to arrive at a certain schedule, or in other words, you're expecting for that stock to break out and it doesn't do that for an extended period of time or longer than what you expect for it to take, then take the loss and just move on. Those are the simple rules for when you should take a loss. They're very important, and they're not rules that you ever want to make any exceptions on. Hopefully the logic and the reasons behind everything today made sense. So no matter what your stop loss rules are, you just need to ensure that you have some in place so that you never damage your account and, God forbid, end your career prematurely. That brings us to the end of the sell rules video. And if anything didn't make sense or there's anything that you disagree with, like the logic behind what I said, do let me know in the comments, because I always am open to constructive criticism. That being said, there are many different ways to trade, and your sell rules may be different than mine. As long as they make sense mathematically, that's all that matters. But if something that I said doesn't make sense mathematically, definitely let me know. And if you benefited from learning from this, or this video gave you some food for thought, that's awesome. That's exactly what the whole point of it was. So I want to thank you guys for watching the video, taking the time to do so. And if you have any questions, please feel free to reach out.